Much of this week's rally was driven by power burns that remained volatile as reporting authorities continuously revised their numbers. Another large decrease in power burn was reported yesterday, this time a drop of 2.37 billion cubic feet on the day. After data revisions, the drop would leave power burn at 46.7 billion cubic feet per day, still a very high level for this time of year. A smaller than expected storage build and a drop in daily output contributed to Thursday's jump of about 6%, pushing the futures to a two-week high. Moreover, weather forecasts are reinforcing this upward momentum, with expectations of prolonged hot weather in the lower 48 states until at least August 4. Gas demand is expected to continue surging. Also aiding market sentiment this week was Vladimir Putin's bid to escape Western sanctions on Russian gas via fertilizer deliveries that he demanded in exchange for reinstating the Black Sea grain initiative that the Kremlin withdrew from. Thursday's rally on the Henry Hub was largely in response to Putin's gambit, which, if successful, would reduce global stockpiling on nat gas. The total number of active drilling rigs in the United States fell by 6 this week, according to new data from Baker Hughes published Friday. The total rig count fell to 669 this week. So far this year, Baker Hughes has estimated a loss of more than 100 active drilling rigs. This week's count is also 406 fewer rigs than the rig count at the beginning of 2019, prior to the pandemic. The number of oil rigs declined by 7 this week to 530, down by 91 so far in 2023. The number of gas rigs fell by 2 to 131, a loss of 25 active gas rigs from the start of the year. As LNG exports have played an increasing role in the U.S. supply-demand picture, nat gas fundamentals have shifted from a nearly insular commodity, with demand fluctuations dependent almost entirely on the weather, to a much more global one. As with any traded good, LNG exports depend on the economics between the exporting and importing countries. U.S. nat gas is generally priced at the Henry Hub, along the north coast of the Gulf of Mexico. Internationally, there are 3 primary price points. National balancing point is the price point of UK imported natural gas. Tidal Transfer Facility, based in the Netherlands, is the continental European price point. Japan-Korea marker is the East Asian price point, generally for Japan and South Korea. A positive spread between these price points and Henry Hub favors stronger domestic LNG exports, while a negative spread, such as was seen during the first half of 2020 during the pandemic, suppresses them. As we can see, the price spread will sharply increase starting from November. This will inevitably push U.S. gas prices above $3 in the upcoming winter season. Thank you for watching. Please like, subscribe, and hit the notification bell to stay updated with our latest content. We value your support and look forward to bringing you more exciting videos. Feel free to leave your comments and suggestions below, we always love hearing from our viewers. See you in the next video.